Japan is choosing inflation, not by accident, not through incompetence, by design. While central banks worldwide fought to crush rising prices, Japan let them run. The yen collapsed, import costs surged, households watched their purchasing power evaporate, and Tokyo did nothing to stop it. This wasn't a policy failure, it was a calculated sacrifice, because the alternative was worse. A nation carrying debt worth more than twice its economy, with fewer workers every year supporting more retirees, faced an impossible choice: control inflation and watch the fiscal structure collapse, or let prices rise and transfer the pain to those least able to resist. Japan made its choice. The question is whether the social contract that enables it can survive what comes next. Japan's inflation problem isn't a problem at all. It's a solution disguised as a crisis. For decades, the country fought deflation with every tool available. Now, as prices finally rise and the yen weakens, commentators call it a policy failure. But that misreads what's actually happening. Japan didn't stumble into this situation, it chose it. The government and the Bank of Japan have deliberately allowed inflation to run and the currency to depreciate because the alternative, continuing deflation with an aging population and a debt burden exceeding twice the size of the economy, was far more dangerous. This isn't incompetence, it's a calculated trade-off. The question isn't whether Japan made a mistake, it's who benefits from this arrangement and who pays the price. Large exporters gain competitiveness, the government gets fiscal breathing room, pension obligations become easier to manage in nominal terms, and Japanese households, especially those without assets or bargaining power, absorb the adjustment cost through higher import prices and stagnant real wages. Understanding this dynamic requires looking past the headlines and into the structural constraints that shape this outcome. The yen has significantly weakened against the dollar over the past few years, moving from levels that held relatively stable for much of the previous decade to ranges not seen in decades. That depreciation has made imports more expensive. Japan imports most of its energy, much of its food, and a substantial portion of its intermediate goods. When the yen falls, those costs rise immediately. Inflation flowed predictably. After years of near zero or negative price growth, consumer prices began climbing at rates Japan hadn't experienced in a generation. The Bank of Japan maintained its ultra-loose monetary policy longer than other major central banks, keeping interest rates near zero even as the Federal Reserve and others tightened aggressively. The gap in interest rates created pressure on the yen, amplifying the depreciation. But this wasn't an oversight. The BOJ made a deliberate choice to prioritize domestic reflation over currency stability. The policy tools were available to defend the yen more aggressively. They weren't deployed because the costs of doing so, tightening monetary conditions, raising borrowing costs, potentially triggering deflation again, were judged to be worse than accepting inflation and a weaker currency. To understand why, you need to start with the constraint that dominates all others in Japanese economic policy: the debt. Japan's public debt stands at over 200% of GDP, the highest ratio among advanced economies. Servicing that debt becomes exponentially harder when deflation persists. Deflation increases the real value of debt over time. It makes future obligations heavier. It reduces nominal tax revenue growth, limiting the government's ability to meet those obligations without either cutting spending or raising taxes, both politically difficult in a society with an aging population dependent on public services and pensions. Japan's demographic structure compounds the problem. The population is shrinking and aging rapidly. Fewer workers support more retirees. Pension and healthcare costs rise as a share of GDP while the tax base erodes. In a deflationary environment, this dynamic becomes unsustainable. Nominal GDP stagnates or contracts, making the debt to GDP ratio worse even if the government runs modest deficits. Deflation also discourages investment and consumption. If prices are expected to fall, households delay purchases and businesses delay capital spending. That depresses demand, which reinforces deflation, creating a spiral that Japan spent a decade trying to escape. Breaking that cycle required getting inflation above zero and keeping it there. That meant accepting some discomfort in the transition. The choice was between managing a controlled adjustment now or facing an uncontrolled fiscal crisis later. But the alternative, remaining trapped in deflation with rising debt and a shrinking workforce, was a slow-motion fiscal crisis with no exit. Inflation from the government's perspective is a release valve. It erodes the real value of existing debt. When prices rise, the purchasing power of past borrowing declines. The debt is still there in nominal terms, but it becomes easier to manage relative to the size of the economy. Nominal GDP growth returns, improving the debt to GDP ratio without requiring painful austerity. Tax revenues rise in nominal terms, even if real economic activity grows modestly, giving the government more fiscal space to fund pensions, healthcare, and other obligations without immediate structural reforms. The mechanism works quietly, redistributing burden across time and across society. This is why the Bank of Japan tolerated inflation running above its stated target, and why it resisted raising interest rates aggressively even as other central banks moved. The priority wasn't price stability in the narrow sense. It was ensuring that nominal growth outpaced nominal debt accumulation. Rapid wage growth, while politically attractive, would disrupt this arrangement. If wages rose too quickly, the Bank of Japan would face pressure to tighten monetary policy to prevent overheating. High interest rates would increase debt servicing costs, undermining the fiscal benefits of inflation. Moreover, Japan's export-oriented industrial structure depends on cost competitiveness. Rapid wage increases would erode that advantage, particularly against competitors in South Korea, Taiwan, and China, where labor costs remain lower. The system is designed to allow inflation without triggering a wage price spiral. Corporations retain pricing power and can pass costs to consumers, but labor's bargaining power remains constrained by structural factors including demographic decline, part-time employment, and corporate governance norms that prioritize stability over wage growth. The distributional consequences are stark. Large exporters benefit enormously from yen depreciation. A weaker currency makes their products cheaper in foreign markets and boosts the yen's value of overseas earnings. Japan's major manufacturers, automotive, electronics, machinery, report record profits when the yen falls. Even if domestic demand remains weak, these corporations hold substantial foreign assets and generate significant revenue abroad. Currency depreciation translates directly into balance sheet gains. Shareholders and executives benefit. Workers see limited gains. Wage negotiations in Japan remain cautious, influenced by cultural norms around consensus and long-term employment relationships that discourage aggressive demands. Households with substantial asset holdings face a direct income squeeze. Imported food and energy costs rise faster than wages. Real purchasing power declines. The pain is most acute for retirees on fixed incomes, single-income households, and small business owners who lack pricing power. Small and medium enterprises face a particularly difficult bind. They absorb higher input costs but operate in markets where raising prices risks losing customers to larger competitors or substitutes. Many lack the capital reserves to weather prolonged cost increases. Bankruptcy rates among smaller firms have started rising as the adjustment drags on. Meanwhile, asset holders benefit from inflation indirectly. Real estate and equity values tend to rise in nominal terms during inflationary periods. Those with diversified portfolios see wealth preservation or growth. Those dependent on wages or savings see erosion. The policy effectively redistributes wealth from labor and savers to capital and debtors, with the government as the largest debtor. External pressures reinforced the domestic logic. The Federal Reserve's aggressive rate hikes created a widening interest rate differential between the United States and Japan. Capital flows responded predictably, moving toward higher-yielding dollar assets and away from yen holdings. That accelerated yen depreciation. The Bank of Japan could have intervened more forcefully, but doing so would have required either raising rates, contradicting the domestic reflation strategy, or spending foreign reserves to defend the currency, a temporary measure that doesn't address underlying flows. Geopolitically, a weaker yen serves strategic purposes. It enhances the competitiveness of Japanese exports in a region where China dominates manufacturing and South Korea competes directly in high-value sectors like semiconductors and automotive. Currency depreciation functions as an implicit industrial policy, supporting sectors critical to national economic security without direct subsidies or trade barriers that might invade invite retaliation. Japan also faced pressure from trading partners, particularly the United States, to avoid excessive currency intervention. The US Treasury monitors foreign exchange practices closely and can designate countries as currency manipulators if they're seen as gaining unfair trade advantages through intervention. Japan navigated this by allowing market forces to drive the yen lower while intervening only sporadically to smooth volatility. The result was a depreciation that supported exporters without triggering diplomatic conflict. The policy creates lock-in effects that make reversal difficult. Once inflation becomes embedded in expectations, returning to deflation risks destabilizing the entire arrangement. If the Bank of Japan were to tighten aggressively now, it would raise debt servicing costs immediately, undermining fiscal sustainability. Higher rates would also strengthen the yen, hurting exporters and potentially triggering job losses in manufacturing sectors that employ millions. The potential cost of reversing course is high. Any government that presides over return to deflation would face blame for economic stagnation and rising unemployment. The path forward is constrained. Inflation must remain positive to serve its debt-eroding function, but it can't accelerate so much that it forces monetary tightening or triggers social unrest. The yen must stay weak enough to support exporters, but not so weak that import costs become politically unbearable. This balancing act depends on households continuing to accept real income declines without significant pushback. So far, social stability has held. Japanese culture emphasizes endurance and collective responsibility, which dampens protest. But inequality is rising. Younger generations face weaker lifetime earning prospects. Trust in institutions shows signs of erosion. The long-term risk is that prolonged adjustment costs fracture the social consensus that enables the strategy. What looks like drift is actually a sophisticated navigation of incompatible constraints. Japan cannot sustain its debt and social commitments under deflation. It cannot rapidly raise wages without sacrificing export competitiveness and triggering monetary tightening that would worsen fiscal dynamics. It cannot strengthen the yen without undermining the industrial base that generates trade surpluses and employment. So it chose the least bad option: allow inflation, accept yen weakness, and rely on households to absorb the cost through lower real incomes and higher import prices. This isn't failure, it's the rational response of a heavily indebted, aging society trying to preserve system stability while managing an impossible trilemma between fiscal stability, price stability, and currency strength. The real question isn't whether Japan made the right choice, it's whether the distributional bargain that makes this strategy politically viable can hold as inequality widens and adjustment costs compound. Every economic system rests on implicit agreements about who wins and who loses. Japan's current path represents a clear choice about where those costs fall. Recognizing that choice is the first step forward toward understanding what comes next.